Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, 12/16, just after the close. A rock'em sock'em week. On our morning call, I think it was Wednesday morning, Moose said, this has been a rock'em sock'em robot week. That was a game from when we were kids. In terms of what we saw this week, a lot of volatility to be expected. Remember last week and 2 weeks back on the equity side, we spoke about weekly momentum having turned down and started to weaken. We're preserving cash in our equity accounts with the thought that we would get a better opportunity to get that money to work. As a matter of fact, I think one of the titles in our video from last week was asking, will patience pay off? We did put some money to work Thursday and then again today. What we try to do on these videos is give you some transparency into what we're doing in the strategies that we manage. Our clients love that. Our friends keep an eye on that. In terms of what we're doing with that capital week to week, that's going to change as the market changes and dictates flexibility. What did we do this week? Equity-wise, in tactical, we had a cash allocation there, call it 20%. We put money to work in DFUV. That's a dimensional value ETF. Reason we liked it, still trading well above its October lows, and it gets us additional allocation into that factor, that value factor. In terms of today in tactical trend, we added a little more energy, XLE. When energy from a momentum standpoint gets down into the single digits, in other words, only 7 or 8 or 9% of energy is trading with a positive weekly momentum number, we like to push money in there. You're starting to get into a washed out area. So we added to XLE. Over in US Core, we added to COWS, C-O-W-Z. Two largest sectors within COWS, healthcare and energy. So we're staying fairly defensive and value driven, but I want to throw something out there. What if growth has become cheap? What if growth has become value here? We have to be aware of where our weakness is. For example, in US Core, as we've gone over all year, we're heavily tilted towards value and defensive sectors, industries, and indices. Where our weakness, where we can be exposed, is if growth really picks up here. So we always want to be aware within our strategies of where our weakness is. And the reason I say this, I was just going over some names. I'll name some individual stocks that we don't own from a compliance standpoint. Take a look at a name in the news every single day, Tesla. I don't know if you've found anywhere near a bottom at 150, but unless this company is really going to fall apart, you've gotten to a situation where its forward growth rate now is starting to dwarf its PE ratio. That's not something that will dictate what day it's time to buy it or sell it, but it does give us a little bit of a pulse of where straight traditional growth sits. Take a look at Amazon, the poster boy for growth stocks for the last 15, 20 years. As a matter of fact, I remember in 97 and 98 when Amazon was trading and was just books at that time, that stock and company was being laughed off the exchange. Very interesting, if you start going forward 12 and 24 months, some of these estimates make today's price at $88 seem relatively cheap. I fully understand that estimates can move up, they can move down, rates can go up, rates can go down, so the discount rate versus stocks can change. But it's interesting enough to have our attention. Some of those names make sense for a long-term bucket. Another thing we talk about, right? Short-term bucket. things that we would trade, things that maybe we think are undervalued and have a 20% move, but that's all. Then you have your long-term bucket, where you think 3, 5, 10 years out that some names in that bucket can be up 3, 4, 5 times what you paid for them. And the way we like to get into those names is by surrounding them. We don't try to call a bottom, but we try to surround a price that seems reasonable to us. So those are some of the names we're looking at. In terms of what we'll do next week, still have that cash hoard. As long as we can trade north of those October lows, we're going to keep putting money to work. We're not going to make a bet that rates skyrocket from here. In terms of rates and fixed income, always a busy week when we get Fed meetings, right? So we saw quite a bit of headlines and so forth off the Powell testimony, post-hike, and what may be going on down the road. What the traders at Cumberland are looking at is the fact that while we talk about where the short-term Fed funds rate has to go to slow inflation, longer term and intermediate term, those yields have come in. They've come down. So you have a bet going on between the Fed right now raising the short term, which they can control, versus investors and traders buying the intermediate and longer term part of the curve, driving those yields down. So always interesting when you get conflicting market data, conflicting market moves, short term versus long term. We'll see exactly where that battle goes. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Enjoy the weekend.